Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Monday the 13th of June webinar. Steve Miley here on the Call for Trader. Welcome, everyone. Apologies for the slightly late start today, but obviously we've got a huge amount going on in the markets. I'm busy in those markets myself, and also we're also seeing obviously a lot going on, so I just wanted to get everything prepped up for you guys. Right, let's kick right in and see what's driving markets right now. I put out the weekly macro update in here last night. Been some few developments since then, but I'll run through, what were the drivers from last week, what's driving through into this week. And really, I mean, I think people underestimate. We were on the call on Thursday when the ECB come out. I think they underestimate what the ECB really did kickstart this. And although it's not the primary driver, and that's certainly the US inflation data, which I'll come to shortly, but it certainly was a driver. And the market started to sell off on Thursday, kickstarted on the downside. Equity markets in Europe selling off, contagion into the US, big sell off on Thursday evening, with the ECB shifting certainly to more hawkish than the market, I think, really had anticipated. Yes, they signalled a rate hike in July. We knew that was probably coming. Yes, they signalled an end to the asset purchase program from the beginning of July. We knew that was coming. But they also indicated potentially more aggressive rate hikes going through through the summer and going into this year, which wasn't so much expected. Then obviously we get the US CPI data came out on Friday, running still very, very hot. Market was expecting this to start to roll over by now. Didn't get that at all. So the core readings and the headline readings on the month-on-month and on the year-on-year, every piece of data in here was above expectations, above forecasts. We got obviously the initial knee-jerk lower, but it was a really aggressive end to the session, very negative session overall. And then really then, that's all been very, very negative in here. But really then over the weekend, on Sunday, the cryptocurrencies got smashed on Sunday and lower again in here today. So Bitcoin in here, 18-month low, took out the lows. Didn't really react on Friday, but took out the lows. And then we do have this positive correlation at the moment between stock indices, stock averages, particularly the US stock indices, the Nasdaq, particularly in here, and the cryptocurrencies. Of particular note, obviously, we're talking about Bitcoin and the US in global stock averages positively correlated. So part of, I think, the acceleration lower in the US was this acceleration lower that we saw on Sunday, and we also had this kind of very negative piece of news as well, with Celsius, which is like a lending platform in here, indicating where have I got? I think I've got that somewhere in here, but indicating a suspension of withdrawals, and real concerns about contagion effects on that, and that's not solely the reason why we're down in far from it, but this is all kind of, it's becoming a little bit contagious, right? So we've got crypto really didn't fall on Friday. US stocks fell on Friday, and then crypto falls on Sunday into Monday. US stocks gap lower in here. No new news for US stocks. All of this news was in. The Nasdaq's down another over 3% down this morning, right? And on no new news apart from then this contagion into crypto. So it's like, it's a domino effect. And then the way it is it becomes cyclical. It's a circle, right? So then one just trips the next one on. Cryptocurrencies broke below their lows, broke below the lows that were posted in May. We've been in like a big consolidation phases on the cryptocurrencies, Bitcoin, Ethereum in here over the last month or so. They've broken below those lows. It said, 18-month lows here on these coins in here. And between 2 and 300 billion, depending on how you measure it, wiped off the cryptocurrency markets since Sunday. And then that's, had a contagion effect back into stocks. Stocks lower in here, say significantly lower in here this morning. But the primary driver in this is all, more hawkish central banks, higher inflation, more hawkish central banks, right? And that's where it's coming from. And all of that is pushing these global risky assets lower and pushing everyone into safe havens. Okay, so we've also seen the dollar surging higher, a really big rally on the dollar. dollar up, yen down, because even though the yen is an ultimate safe haven, the Bank of Japan are going nowhere, right, with their rates. So higher rates in the US, Bank of Japan going nowhere. Interest rate differentials widen. That's a primary driver of FX markets. So dollar yen going even higher. Dollar yen hitting its highest level this century. Get that, since 1998. So right, let's just parry back a little bit in here. So that was the main drivers are still in here, but we're seeing significant breakdowns through technical levels. So I'm going to double check the Dow, but I mean, this morning, last time I looked here, the Nasdaq and the S&P have both undercut the lows that we'd set in May, and we also gapped lower. So we initially gapped lower on these markets, on the futures markets. So we've got a gap on the futures markets. We're going to have big gaps on the actual cash indexes. When you look at the cash indices, they're going to show big gaps because obviously we're even lower now. But even when we opened last night, Sunday night, in the US, Sunday afternoon, Sunday evening in the US, the markets are already gapped lower on the US equity indices, and then plunged even lower after that. Okay, so we'll definitely get this contagion effect coming through in here. European indices obviously significantly lower. Asia was significantly lower as well. Right, let's take a look at the whole week now. I know today's data is going to be important, but we don't really have too much to really focus on. We've already had UK GDP. That's added fuel to the fire in here. We go and look at the daily calendar. Hopefully, here we go, dedicated. So we've already had this GDP data in here, and this is what the markets are super concerned about as well. Is we've spoken about this past, stagflation, right? Inflation and stagnation, called stagflation. We get recession on top of inflationary pressures, and we haven't had that for decades. Back in the 70s, really, into the 80s, maybe it was the last time we saw stagflation. Even I was young when that occurred, right? So, but look at this GDP and industrial manufacturing production data out of the UK this morning. Yeah, remember, UK is pretty much fairly similar in its situation to the US. Inflation running very, very high. And the economy is strong, but now rolling over, and this is a real worry. This is what we're concerned about: stagflation, right? Actually, seeing that inflationary pressures now starting to have a negative impact into the real economy, and seeing growth, and have an impact on growth. So GDP, and you see everything's red, missing expectations. GDP on the month-on-month. We expected 0.1, came in minus 0.3. On the year-on-year, 3.8, 3.4. And look, we're just sitting above. Remember, a recession is 2 quarters of negative growth. That's the economic definition of a recession. 2 quarters of negative growth. So in here, we had 0.2%, a plus 0.2%, but we were expecting 0.4% on the quarter-on-quarter. So getting close to posting a potential potential negative quarter. Okay, first negative quarter. Industrial production, manufacturing production numbers also worse in here than expected. We do get Brainard today. Okay, so going to be interesting to see what Brainard says. I find that quite usually there's it's always at least a 1 week. I'm not quite sure why Brainard's speaking there, because we had the Fed this week. I'll talk about that in a second. But usually it's a 1 week curfew on Fed speakers, so I'm not quite sure why Brainard is speaking there today. That's odd. Usually there's a curfew ahead. I'm sure there's a curfew ahead of what used to be a curfew. Anyway, let's go back. So the focus this week now really is going to be all on the Fed. Primarily on the Fed in here. Just to note, though, we do get the Bank of England on Thursday, okay, and then they're anticipated to raise rates for the 5th time in succession, up by another 0.25. That's up from 1 to 1.25, with an outside chance of them actually raising by a half, by 50 basis points. That would be a shock to the market, a surprise to the market, and just show how the severity of the situation. And also then, but there's a lot of calls for them not being so aggressive, because obviously the UK heading towards recession. And then I think the Bank of Japan, keep an eye on the Bank of Japan in here. Still, very much after last week, we've already spoken about the ECB. The ECB and the Bank of Japan have been the world's dovish central banks for decades now, right? They stay very, very dovish. However, we've seen the ECB now shift to a more hawkish stance. Okay, very slow to move compared to, say, the UK and the obviously the Fed and the Bank of Canada and the Reserve Bank of Australia. They're slower to move. However, the ECB have now moved, but will the BOJ start to move? The BOJ have seen no signs of moving. Okay, very much defending their zero rate policy, very much defending their targeting of low yields right across the yield curve by defending the Japanese government bond market. Still huge amounts of quantitative easing going on, and still very much dedicated to that. But look at dollar yen. Dollar yen surging higher. Okay, surging higher, and that's obviously something that they're going to be concerned about. So that's yen weakness. And but yeah, potential yen weakness is not good for inflationary pressures. So certainly I'm going to be keeping an eye on that as well. Even though nothing really expected, who knows? Okay, and with everyone else shifting very, very hawkish, there is some more data in here. Probably the other data of note in here is going to be the US retail sales numbers in here. Tomorrow we do get UK employment report, German CPI, inflation numbers out of Germany. It's going to be important. So we're going to keep an eye on that. US PPI numbers as well tomorrow, German ZEW survey. US retail sales is really the standout from a US perspective going into this week, alongside clearly the Fed. Okay, now let's jump and talk about the Fed in here, because I'm going to show you the dot plot chart in here, or not the dot plot charts, the CME tool, which is basically just telling us where the expectations are on the CME futures market for the interest rate curve, where we're expecting the rate hikes to come and how big. Remember this column in here, okay? This is the column in here for 50 basis points this week on Wednesday, okay? This was all the way up here when we spoke on, I think, Friday, ahead of the CPI data. Yeah? It was way into the 90s, okay? It was all the way up here. You can show the chart of that in here. Historical. I'm not sure how well it shows it though. I'm never really that happy with it. So let's go back to that. Okay, 15th of June, sorry. Just go to the current. And so we're looking at 125 to 150. Let me see if I can just do that. Just narrow that down to 125 to 150. It's this one here. Oh no, it's taken the 125. Oh, let's take all the others out. That's what we need to do. Oh, no, leave that one in. Okay. Why is that drop? Oh yeah, so up here we were expecting the 125 to 150. Look, it was basically nailed on 125 to 150. Okay, so that is where we are, right? So that's the current. Okay, this is going up by 50. Remember, we're 75 to 100, and it was expected to go to 125 to 150. So that was up here, right? So if I go to the historical, it was up in the 90s. No, they've all repopulated. That's annoying. In here, so okay, so we were up in the high 90s, 98%, 97, 98%. So basically nailed on for a 50 basis point hike. Okay, now you see it's fallen here just in that day. Okay, down to 76.81. Okay, and what that's shown us is that the market is actually now pricing in an outside chance now. Outside chance of 75, and it's a good outside chance, right? It's a 27% chance now of 75 this week. Where basically we were pricing in no chance of that, just on Friday ahead of the data. Okay, so a real chance of that coming through. Now, if we step out to July now. Okay, now remember this column here now represents, that's 175 to 200. We're currently 75 to 100. So this is a total of 100 basis points worth of hikes, okay, going into the July meeting, okay, by the July meeting. Now, what this is telling us now is there's only a 7%. This was all the way up here, right? This was really high as well. This one is just an outside chance. So now the market is telling us 200 to 225 is a total of 125 basis points of hikes by July. That's where the money is, okay? That's where the probability lies. So that's telling us there's more of a chance that we're going to get a 50 and a 75 in some combination between June and July, okay? And there's even an outside chance of even more aggressive. This is then basically saying 150 basis points of hikes, outside chance of 275s, good chance of a 50 and a 75, more likely by the June one, obviously, in here. There's only a 28% chance of in June of a 75. So this is telling us there's more and more a real good chance now of in July of a 75, and only now 30% chance of it being a 50 and a 50. Okay, so clearly this is telling us the market has priced in a far more aggressive interest rate hiking cycle since, by at least 25 basis points into the July meeting, and potentially even an extra 25 than we were expecting. Okay, right. Let's go to 5 things to start your day. There's so much to go through in here, guys. Right, so let's have a look. Meltdown continues. The forecast inflation numbers, blah, blah, blah. With traders now factoring 255 basis points of tightening for the Federal Reserve in its 5 remaining meetings this year. So 255 going into this year. Crypto crumbles. We've already spoken about that, in reaction to that. An even more aggressive sell-off in here on the crypto side. That's showing in here as a reflection of contagion, okay, a real reflection of potential contagion. And we spoke about Celsius, okay, in here as well. Fraser reading seems to suggest a further shift in the drive of inflation from goods to services, but don't write the supply shock off yet. So, all showing very, very negatives in here, and also in real concerns about natural gas and coal from the energy side. Okay. We've got some other stuff going on as well, just in case you didn't already have enough to worry about. More worrying signs of increased Chinese saber rattling over Taiwan, so that's a concern as well. Okay, and then obviously data calendar is quite So look, Fed Brainard is due to speak. Okay, so Brainard is due to speak today. Right, what else do I have in here? Right, okay, this is an important thing as well. It's not just stocks. It's not just equities in here. It's also the bond market. Huge sell-off rocks the treasury market. Okay, treasury is getting smashed as well. If we go and take a look at the charts in here, okay, I've got this on ZM. That's no good. Let me add in the I'm going to roll these as well. Now, do remember, guys, a lot of the futures contracts are rolling or in the process of rolling from June into September. Okay, certainly with the equity markets, you could be looking at the June contracts. You don't need necessarily to be looking at the June contract. They're both very liquid in here at the moment. But what I would say is probably better to be now looking at the September contract for the Nasdaq and for the for both the Nasdaq and for the S&P 500 and the Dow. Okay, but look at the treasury market in here. Let's focus in on that first of all. Okay, and this is on the September contract on the 10-year. So on Friday, we'd already plunged lower in here, getting close to the lows that we posted back here in May, and look, accelerated through them. This is in pre-market trading, right? We're not even open yet, and you can trade bonds, okay, but then the real market is not fully opened yet, okay. But look, we got down to the May lows and then plunged through those on the futures market, and yields obviously going to new high yields. That's a real concern in here. Let's go back and then the yield curve is inverted, okay. Now the yield curve inversion, okay. Now we've had kind of parts of the yield curve previously invert, okay, and that is a signal of potential recession when the yield curve inverts. And what we've seen here, 2-year yields have moved to their highest level since 2007, and where are we? 210s, I think, the 210 years, the 2-year, 10-year, okay. So we did dip below, okay, but we're basically the inversion. So we inverted the 3-year, 10-year, and 5-year, 30-year, inverted on Friday, okay. And the 2s, 10s now on an intraday went to -2 basis points on Monday. Okay, so we did go sub-zero. So we inverted again, having previously inverted back in, I think this is early April. We had an inversion back then. So real concerns in it. And this was, I think on the running or around the invasion. No, that was way, that was no, February, right? No. So this was a part of the concerns around the Ukraine. I think we saw the inversion here. And also the Fed was shifting more hawkish as well. But now we're re-inverted, okay, in the 2s, 10s. And that was in the other sections of the curve. So that's a real negative. That's the bond market, as well as, moving to this new low price, high yields, okay, that's the bond market telling us we're certainly in a more negative position. Okay, in here, real concerns around inflation. We're going to run through some headlines. So global route deepens as outside rate hike in play. Extended setup could push S&P back 500 towards a bear market. Well, we remember right on the lows previously, we were basically right at bear market territory. At the May lows, we did kind of intraday signal bear market. That's 20% off the highs. We're going to be very close to signaling that again today. Okay, we're down 2.5%. Nasdaq over 3%. Okay, Fed hike of 75 basis points is a done deal for some traders. Well, we looked at the tool in here. It doesn't tell us it's a done deal, right? It doesn't tell us it's a done deal in here. It still says that the real chance is going to be a 50. Okay, not a 75, even though that's saying that on that headline, somewhat disingenuous. Okay, US bond flags recession risk with 75 beta hike in play. Yes, it's in play. Okay, and certainly the 2-year bond is telling us maybe. Traders supercharged sell off for bets of supersized rate hikes. It's all the same headlines really. Oil extends lower, so even oil getting hit now. Okay, even though the inflationary pressures, this is recessionary pressures in here. A negative for oil, right? If there's a recession, there's less oil used, right? Lower growth, less energy used. Okay, so that's been a negative in here for oil. So oil lower, Bitcoin tumbles to 18-month low, contagion impacts and inflation concerns spreading. What else do we have in here? All the same headlines out of Reuters as well. Got a load more headlines. So Celsius, we spoke about that in here. Freezes withdrawals. That's in the crypto market. What else? Major crypto lender Celsius freezes withdrawals as market tumbled. Oil's off the highs. Oil falls on Beijing's COVID-19 worries as well, concern about, and then inflation concerns as well. Dollar driver yen tumbles to 1998 low, so the dollar's strengthening across the board again in here this morning. And then in here, Nasdaq down 3%. Okay, so everything we've kind of already discussed, all the headlines telling us that. Let's take a look at some charts. Now, just going back to the roll in here, guys. Yeah, would suggest you do roll now. I'm going to try to go to in here. If I go and take a look at I think if I go in here, then it would be good. Okay. Trader quick tips. This is where you want to go, guys. Trader education, trader quick tips. If you don't know about the role, okay. So in here, which listed month to trade? Take a look at this one, okay. And how to find the contract code. Okay, which listed months to trade, more information on liquidity here. Check out these videos, okay? They're great little videos, they're only short, okay, and it'll tell you how you decide which month you should be trading and how to find out where the liquidity is in the market. Okay, so check out these videos on the trader quick tips so you know which month you should be trading, yeah? And particularly if you should check these out, particularly if you're trading like oil and gold, because they're not just your standard 3-month rollovers. They're rolling over on a monthly or bi-monthly basis depending, and the liquidity can shift to different months. It's not just necessarily the next month out. It can sometimes jump to 2 months out. So it's important to know how to check for the liquidity, where the liquidity is in here. Let me just see if I can open this one as well. There's another little it's got in our FAQs as well. How to find the most active. I know so we've got the video on it in here. How to find the most active month to trade in here. So getting ready to trade in this whole section of our education. So there's loads of education in there, guys. Please do go through, check it out. Loads of really good stuff in there. But this one, how to find the most liquid month, and then also in here this video on which month you should be trading. So check this out, which months to trade. Okay. What else do I want to say? Yeah, so let's go back to the charts in here. So I think we should be, I'm going to bring these up now and get rid of my June contract ones. Now the good thing we've got is actually the difference between the rollovers hardly anything this month, right? Is like literally a couple of cents, or not even that, I think. So the difference between the here we go in here. So I'm going to start off with the daily, and I'm going to get rid of my June in here, so they're off, and we don't have to go back to these. We'll trade on we'll be looking at the ESU, and I'll add that in. So we've got a daily, and I've got an intraday as well. So if we look at the daily in here, so there's the gap on the open, and then the market, plummeting after the gap as well, and then, we did undercut the low in here, and we're sitting right on the low, on here. And then if we go take a look at the Nasdaq, going to bring those up as well. I'm going to change again, roll these over to the September contracts. You can see in here, I'm going NQU, picking the September with the U, okay, and we'll get rid of the two that I have here. Sorry guys, but actually I won't bother deleting these, and next time I'll do it for the Dow as well. I do want to show you something on the Dow in here, but I will add in one more of these. So I've got it on both time frames. So I tend to set mine up. So rather than having to switch the time frame, I've got me on my longer term chart, and I've got my shorter term chart up, and I can switch this for 5-15 minutes, but I've always then got the daily accessible. That's the way I like to set up anyway. So yeah, let's go back, and I am going to add in the Dow, but I'll watch what go put you through the YMU. So YMU on the Dow, because there's something particular I want to show you on the Dow. So if we look at the S&P, yes, we've undercut the low. And if we look at the Nasdaq, I hope this is still the case. Yes, we've undercut the low, and again the gap. That's the gap, and then we've undercut the low. If we go and look at the Dow, okay, the very small gap, haven't undercut the low yet, right? Now, going back to Dow, so the Dow here, the Dow Jones Industrial Average, is named after Charles Dow. He wrote a series of essays in the Wall Street Journal back in the late 1800s. Here's a history lesson, okay? Hopefully you won't phase out. But he wrote a series of articles in the Wall Street Journal, which then became put together actually after his death in the early 1900s by a friend of his, and became known as Dow theory. And that takes, that's the basics of modern technical analysis. It comes from Dow theory and from Charles Dow. And one of within his theories, he had one of his tenets, one of his principles was that the averages must confirm each other. What he was talking about back then was the Dow Jones Industrial Average and Dow Jones Transport Average. Those were the only two averages there were back then. And then that utilities were added in a bit later, I think. But the Dow Jones Industrial and the Dow Jones Transport averages were the two main averages at the beginning. And the reason he had for those confirming each other, what he basically meant was, if the Dow Jones Industrial Average goes to a new high, the Dow Jones Transport Average needs to go to a new high, because these are both, they are linked parts of the economy. You can't. It's not the belief that industrials can keep going if the transport sector is not there to support it, and transport's not going to grow if there's no industrial base to need to transport around, right? So that's the idea behind it. So when the Dow Jones Industrials went to a new high, if after some time the Dow Jones Transport Index didn't go to new high, that would be kind of like a non-confirmation. It'd be like similar to like a divergence. It'd be a non-confirmation of one going to the new high and the other one not going. And if you wouldn't say on the day it had to do it on the same day, but over a bit of time. Now, what's interesting to me here on a very short, and just taking this now to a more modern look in here, is that what we want to see in here is all the indices move into new lows, all the indices breaking through this low. Now, what we're not seeing is the Dow, and although the Dow has become less important and people think it's less important than it used to be, and it probably is, that's probably about right. The components of the Dow are not probably reflective of the US economy that they used to be, years and years ago. However, they're still very much watched. It's still very much traded. It's still very much used as an investment tool and a benchmark. So the fact that this hasn't undercut the low, I think, is significant. Yeah. And if it holds the low, then it's probably telling you something. It's probably telling us something. Maybe we're getting done. Now, I know you guys think I'm the eternal bull, right? I'm not the eternal bull. I was bearish on Friday and we plunged, And coming into the day, you got to say it's pretty negative. But do you want to be... Look at those three candles, guys. We haven't had three candles like that, for this whole sell-off. We've had some pretty negative candles in here, right? But not like this, right? So these three candles certainly very, very negative. And it could be signaling the beginning of the end. This could be signaling the beginning of capitulation, right? Or it could actually be signaling that capitulation is happening right now. One of the problems, what I would tend to look at right now is I'd be tempted to look at volume numbers and open interest numbers. Are the volume numbers and the open interest numbers telling us that the market is capitulating? Are longs getting out and capitulating? Is the open interest on the long side falling? Also, is the volume high? Yeah. Unfortunately, you can kind of work this out, but it's not ideal. We've got the rollover going on, right? We're right in the middle of the rollover, which means the volume between June and Sep, a lot of that volume is the volume rolling from June to Sep. And it's really difficult because we're right in the midst of rollover, right? So basically, we've got 1 month, one more week. The June contract expires on Friday of this week. From today, September becomes what's known as top step, right? So not top step as in our competition, but it becomes the top months, right? It's the main months to trade. And so on Friday, there would have been a lot of rolls going on. A lot of institutional clients would have been rolling their positions from June into September. So the volume is high in both months, okay? It's higher in both months. And that a lot of that is just either selling June to buy Sep or buying June to sell Sep as they roll either their shorts from June into Sep or their longs from June into Sep, depending on which way around you are. So it's very difficult to get a real handle on where the outright volume is, okay, in here, and get a definitive volume number in here. So it'd be interesting. And also, it might be, I'm going to take a look, maybe I'll bring this to tomorrow's webinar. I'm going to take a look at the cash market volumes, both yesterday, but also what the cash market volumes are going to be like today, going into the day. In the first hour, particularly the first half hour, the first hour is going to be important to see, are there real liquidation pressures? Because today could be liquidation, the big like capitulation liquidation day. Now, I'm not saying you're going to stand in front of this and try and, what we say in the market is catching a falling knife. Catching this is like catching a falling knife, right? Why would you want to try and catch this? But the markets are down a lot already today, right? We're down over 3% on the Nasdaq, right? It's a big day down already. Is it going to drop another 2-3%? Probably not, right? Could it drop another 1.5, 2? Potentially, yes. But is there a chance for a rebound today? Yes, there is as well. Now, I don't want to sound like the eternal bull, but don't, just because we've had this happen, don't think. And when it's the worst time, right? When it feels the worst, that's often the time to be buying it, right? And it feels like I've been doing this a long time, guys, 30 years. And it feels like we're getting to that point of capitulation. It feels like we're getting to that point of panic, right? The crypto market's telling you that. The bond market, this move in the bond market, going back to that bond, where are we? On the ZNU, this bond market move, yeah, this inversion of the yield curve, yeah, the dollar yen moving to the highest point this century for 1998, I said, right, 23, 24 years, okay. All of that tells me, yeah, that markets are massively pushing to extreme positions, okay, and when they get to extreme positions, that's often when they reverse. Okay, so I'm not saying it's coming today. I'm not saying it's coming tomorrow. My gut tells me it's coming very, very soon. My gut almost tells me it's what could be today. Okay, could be this capitulation bottom. Okay, having just done this a long time. That's nothing to do with the charts. That's just taking all that information that I just ran through there. Okay, so but right now you look at the chart. If I go into the 15-minute, who's buying that? No one, right? And where am I on this? I'm bearish. But just watch out, right? This is the 15-minute chart on the S&P. This is the gap. There's the gap. There's the price action since the gap. Where do you draw your trend line? Where could this? Now we're sitting down on the lows. I'm not saying don't be short. Be short. Happy to be short, right, guys? But I think on the cash market open, you're going to know a lot more. And we could, if it goes lower, just go with it. I'm not saying don't go with it. What I'm saying is just be careful. Just be wary. Don't get tied to the, oh, it's going down. It's going down. It's all really bearish. Why is it going up? Why is it going up? Oh, it should be going down. It should be, but it's not, right? This is the kind of time when longer term investors like George Soros, right, like Warren Buffett, that's when they come in and step in. That's when they step in, okay, and they start hoovering up, right, when there's real value. At this capitulation, when everyone else is selling, the smart money buys, right? And it feels to me, you don't want to be in with those everyone's selling. The real, most of you guys on the platform of what we call, pro tail, right? You're professional retail, or you're semi-amateur, you're semi-professional, right? You're not pure retail. You're not just picking up your phone and going, oh, look, oh, that's really, really bad. I'm selling now on the open, right? Because now is probably maybe too late to have sold. If you sold up here this morning on the gap, yeah, great, right? But maybe not right this second, okay? Maybe it is. Maybe those guys will make money, but I'd be looking for this potentially to rebound and just watch out. But for right now, on that chart, I'm bearish. I'm a technical analyst. Lower lows, lower highs, Dow theory, below the trend line, even on the 50-minute chart. Just on today's data, it looks negative. If I go back and do any longer term chart, obviously it's going to be super negative, right? It's going to be all, again, this is the sell off from last week. Get the longer term chart line. Clearly it's negative, right? I'm not making out a bull case. What I'm just saying is don't get tied to the bear case, because this can turn in a dime, right? This can easily just turn around, right? There's a more accelerated line. We're kind of cutting above that more accelerated line. It's not particularly useful, but that's showing you this is actually, this is the move down from the 10th. So that's Friday, right? That's the CPI data. So if you look at the move down from the CPI data, this trend line in here, we're actually now slowing because we've reversed this trend line. We're broken above this trend line. Yeah. It's very accelerated. I mean, it's not particularly useful trend line, but that very accelerated trend line that comes down from Friday's. So there's obviously that's the data being released. Let me get this actually on the right points. That would help. So annoying. Actually click right onto it. Why is that doing that and not pivoting? Oh, there, that pivot there. I might as well just redraw it. Gosh, time I do that. Right, there we go, boom. But if you look at that channel, the market's actually gone back. So this descent is slower than this descent we saw through here, okay? Now, I'm not saying that's a bullish signal, but it's showing that the market's starting to slow. It's starting to try and bottom. You can see in here, right? This, if you come down here, it's starting to gradually turn, yeah? And I'm not saying it's not going lower. Please don't, think that I'm saying that, right? But what I'm saying is just watch out. If it takes above this little high here, if it breaks this little counter trend line, this could easily go. If it goes and fills the gap, you're going to get this. You just imagine in here, this turns around and goes back and fills the gap. You're going to have this really aggressive, positive hammer candlestick down here. It's going to undercut the low there and rebounded. Remember, around here on the S&P is like 20% down, right? When we undercut this level here back in May, we were 20% down intraday, but didn't close 20% down. That's the official recognition of a bear market. Sitting here right now, I'm pretty sure we're in bear market territory. When the cash market opens, it's going to open in bear market territory. It turns around and closes that gap. It's closed an opening gap. It's come off this low in here. It's rejected the 20%. Now, I'm not saying that's going to do that, but if it does, this is going to be a real rejection of the downside. And then I can easily see it will be back up here in the next week, okay? When we get to peak bearishness, the Fed's going to hike. If the Fed hikes 50, yeah, the market, will say, okay, is that it? If the Fed hikes 75, the market might actually like the Fed hiking 75. The stock markets might like the Fed hiking 75 because it shows the Fed are trying to get back ahead of the curve, okay? And so if the Fed do hike 75, you're going to get loads of people hitting that sell button thinking, oh, this is really negative. This is a more aggressive hike. It could easily rally on that, okay? So we're coming to a real point of, that's why this might not be the bottom, because we do run into the Fed. But I wouldn't be surprised to see value buyers coming in. It might go lower first before they come in. It might go lower today and turn around from lower today. It might go lower today and tomorrow and then turn around into the Fed. It might carry on going down, right? All I'm saying is, please be wary. Now, I realize the webinar is running on in here. I'm not going to go through all the same stuff in here for the Nasdaq and for the Dow, yeah, but suffice to say, it's the same kind of analysis you need to do on those guys, okay? And please do go and do it. And just watch out for those levels. I'm just going to do a quick nod to the guys who I know out there trade the oil and gold, because we do have plenty of clients doing that. So look at gold in here with this super aggressive move higher in here, and now a significant retracement, a super aggressive move higher on Friday, a retracement of that, and now we've retraced over 50%. That's a bit of a failure. That looks worryingly negative in here for gold. Not quite at the 50%, just holding that. It's just holding above that 50%. If we undercut the low in here, I'm not got no strong view in here. If it undercuts the low, can see it back down to here. We've also got a trend line. You've got a potential double bottom as well. Again, this is going to be reactive to the equity market open. So it's trying to put a bottom in. Comes across above that high there, back above 1862. It looks bullish. Below the low here, 1855, it looks pretty bearish. Yeah, so it's up a decision point from a day trade perspective. Let's go take a look at oil on the 15-minute chart in here. So I'm going to zoom out to the daily first of all. So lower, did have a strong rebound, but then given up that rebound for Friday. So after Friday's rebound, it looked bullish. You look at my daily technical analysis. It's painting this as bullish, but it's undercut the low already. This now for me looks pretty negative. After this Friday's like down, boom, up, down again, boom, back higher, but then giving it up already this morning, chopping around. For me again, it's chopping sideways, but the risk for oil is lower in here. But again, it's going to be dictated a little bit by the equity charts. And a quick just look at the dollar chart in here. Boom, almost back up to the highs that we saw back here in May on the dollar. Okay, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. It's going to be a tough one out there. Keep the position sizes small, guys. Please don't blow your accounts, okay? Don't blow your accounts. Trade the micros if you have to, yeah? Trade the minis, trade the micros, okay? Trade smaller because there's plenty of price action. There's plenty of movement in the market, right? We've already moved 3% on the Nasdaq today. You don't need to get over leveraged, okay? Trade smaller, take a bigger move. All right, please do that. I spoke a lot today. Please do send in. We've had a load of people sign up recently. Please do send in any, please do send in any questions you have about the webinars, any feedback on the webinars. Much well received. I know a lot of you are not watching live. If you do watch live, put in there's a chat box underneath the where the webinar streams and the traders room. Stick in a comment in there if you're live and ask me something as I go live. Right? Okay, it's better to have that interaction. Don't forget to do your rollovers. If you're rolling to different contracts in here, make sure you're trading the right contract. Check out the videos that we've got on the quick tips videos. And I'm going to wrap it there. I'm still rattling on. There's plenty of trading to be done. Go do some trading. I'm going to wish you all a great trading day. Stay safe out there. Helmets and goggles on. Be careful. Trade small and be great. Okay. Take care. Bye.